Put options explained. Buying, selling put options. Ladies and gentlemen, in this video, we're going to be talking about put options. Buying them, selling them. What are the pluses and minuses of buying them? What are the pluses and minuses of selling them? We're going to go over a few things. In fact, let's look at everything that we're going to go over. Here is your handy-dandy table of contents. This is exactly what we're going to be covering in this video. And if you're not familiar with YouTube chapters, you can take your cursor and run it along the bottom of your video player, and you'll notice that bar that shows you where you are in the video, the timeline. If you put your cursor over that, you'll see that bar is broken up into little segments. Each one of those segments is a chapter. So you could click on one of those segments and it will skip you to this chapter. So if you feel like it, you can watch this video all the way through. You can watch all the chapters in any order you want. It's here for your disposal. Do whatever you want with it. In fact, this video is mainly like a theoretical, educational type of video. And if you're the type of person that's not into theory, you're into action, then look up here. You're going to see a link to a video that talks about the easiest place to start. Now, if you feel like it, you can click on that and you can watch that video and get started a little faster. However, if you want a little more education on the theoretical side to make things a little more understandable and you're moving into the action mode, then let's get into those jargon terms, my friends. The first jargon terms we're going to go over are applicable to the stock market in general and also applicable to almost any type of trading markets. First two terms we'll talk about is bearish and a bullish. Bearish is the direction of moving down or negative on something. So for example, if there's a particular idea that you don't like, you could say I'm bearish on that idea. If a stock is moving down, then the stock is bearish. If the stock is moving down and you use a put option strategy that profits when the stock is moving down, then that is a bearish strategy, right? So bearish is when something's moving down or it's like negative about something. Bullish is the opposite. It's the direction of moving up or positive on something. You like an idea, you're bullish on that idea. The stock is moving up, it's bullish. You're implementing a strategy that profits when the stock is moving up, that's a bullish strategy. The next two terms we're going to go over are short and long. Short is selling to open a position. It's often associated with the color red. Short put option is the same as saying sell put option. Now some people are going to hear that and you might be thinking, wait a second, how do I sell something I don't own? That's a really, really good question. This jargon terms though is not to be explaining the most depth, intricate details of all the different plumbing of the stock market. This is just to kind of get your feet wet in these jargon terms. You might even need more education on these different terms. This is basic thing. So if you're having that question, I want you to put that aside for a second and I want you just to be comfortable with the idea that short means selling to open a position. And long is the opposite. Long means buying to open a position. It's often associated with the color green. So long put option is the same as saying buy put option. Now notice something. In both of these scenarios, we talked about open a position. Sell to open, buy to open. Well, if you could open something, could you also close something? Well, ladies and gentlemen, in the stock market, you absolutely can. So if you are going to sell to open, you're going to do the opposite to close. You're going to buy to close. If you're going to buy to open, you're going to do the opposite to close. you're going to sell to close, right? Short means sell to open. Long means buy to open. When you sell to open, you buy to close. When you buy to open, you short to close. Now, these terms that we're going to get into are specifically geared towards the options market. Now, I first learned about the options market through the US stock market, and I would wager that most people are familiar with the options markets through stocks. However, it's good to know that options can be applied to a variety of assets. It's not just limited specifically to the stock market, but we're gonna, in this video, we're gonna be talking about the US stock market. And why those two? Because number one, I live in the United States, and number two, I trade in the stock market. So that's what this video is about. So the first term that we're going to be talking about is expiration date. The expiration date is the length of the option contract, whether it's 1 day or whether it's 200 days. The amount of days really doesn't matter. What's important to realize is that every option has an expiration date, has a certain amount of days that it's valid for. If it doesn't, it's probably not an options contract, right? So options contracts, they have expiration dates. This next term, strike price. The strike price is a predetermined price to sell or buy the stock at, right? So a strike price is a predetermined price that a stock can be sold or bought at. Premium is the amount of money paid to purchase an option contract, right? Premium is the amount of money paid to purchase option contract. These three terms are going to come up really often. We're gonna use these terms again in this particular video. Underline the stock or asset the option is applied to. For example, if I sell a put option on Johnson & Johnson, then Johnson & Johnson is the underlying asset. Right? So underlying is the stock that the option is referring to. Contract size, the number of shares or assets in one option contract. In the US stock market, one option contract equals 100 shares of stock. One contract equals 100 shares of stock. This is one you definitely want to keep in mind. Intrinsic and extrinsic value. Not necessarily used as often as strike price, expiration, premium. Not necessarily as often, but good to just have an idea of. So the first one we'll talk about is intrinsic value. When the price of a stock moves below the put option strike price. Let's give you an example. Let's say that there's a stock trading around $15 and I buy a put option with a strike price of 10, right? So the stock's trading around 15 and I buy a put option with a strike price of 10. At that moment, as long as the stock price is above $10, there is no intrinsic value in this option contract. Why is that? Because intrinsic value is when the stock price moves below the put option strike price. What's the put option strike price? 10 in this case. What's the stock trading at? 15. If the stock falls in a bearish movement, like downward movement, and it goes to $8, now there's intrinsic value in this put option. $2 of intrinsic value because it's at 8 and the strike price is 10. So that's intrinsic value. Extrinsic value is other components that make up the option's price, such as Greeks and dividends. Now, you've heard of dividends before, and you don't quite know it, but you actually have heard of Greeks. Option Greeks. various factors that might affect an options contract price. So I said that you've heard of Greeks before. See this one right here, theta? Theta means time. And we were talking about the expiration date, the days till expiration. So days till expiration is one of the Greeks, but it's the term theta is used. You see how these jargon terms can just really get kind of confusing? So what I want you to grasp here is that you've got various factors that go into the options price, right? These Greeks, specifically, let's go back to theta, time. If you have 200 days till expiration, you have a lot of extrinsic value from the Greek theta. You have a lot of extrinsic value from the amount of time in the contract, right? Now, obviously there's more Greeks there, but this is not about understanding all the Greeks, just to give you this idea that there's a certain amount of value to an option contract's price that comes from these other things, the Greeks, and that these Greeks play a part, because when we're talking about value of the contract, eventually that links to you being profitable. So you just want to understand that there's these Greeks here. We're going to end up talking about those more through this video. At the moment, let's go through some history of put options. Options can be traced back to olive trade in ancient Greece. Quoted from Investopedia, but this is not the only place I've seen this before. I don't remember where else I've read this, but I have read numerous times about options being traded back. I think it was like Epictetus or something like this. Like, I read these different stories. So options contracts have been around on Earth and humans using them for a long time. Put options, specifically in the US, were traded as early as the 1920s, as far as recorded history. And in 1973, the Chicago Board of Options Exchange was created, which standardized all this options trading that was going on previous, up until then. It was a little bit of the Wild West of options back in the day before the Chicago Board of Options Exchange standardized everything. Put options were originally used as a way to insure an asset. Think about your car insurance. It has an expiration date. It kind of has a strike price, but you wouldn't call it a strike price. It's not exactly the same, but you got certain things that you're insured on, right? And you pay somebody for that. So that means you're buying car insurance. You're going long car insurance. You pay a premium that has an expiration date, and it has sort of like a strike price that if certain things happen, then other things happen, right? And you pay that out, and someone else on the other side, they take that in. It's similar like that. A put option was originally created as a way to insure stock position. But over time, various ways of using put options alone or in combination with other puts and call options were created and discovered. And now there's like a whole plethora of ways that you can implement using put options in the different markets. So we talked about the history, we talked about some jargon terms, but we haven't completely defined in one sentence what is a put option. Let's do that right now. A put option is a legal contract that gives the buyer the right to sell 100 shares of stock at a predetermined price in a specific time frame. The predetermined price is called the strike price. The time period is called the expiration date, or days till expiration. All right, you're probably getting it by now because we've been doing a good job of studying here. So let's talk about what are some very, very basic fundamental differences between buying and selling put options. Right? Over on this side, we got the buying side. Over on this side, we got the selling side. So when you buy a put option, you have rights. You have choices. When you sell a put option, you have obligations. Also, a big difference is which way the cash flows when opening the position. When you buy the put option, you can probably guess the cash flows out. When you sell a put option, you can probably guess the cash flows in. And just like when we went back into jargon terms, right? When we're talking about long and short, how you open and close is reversed. Same thing here. It's the same. We're talking about the same stuff over and over. Which way the cash flows when you close the transaction. When you buy the put option, cash flows out. When you close the put option, because you sell to close, cash flows in. When you sell the put option to open, cash flows in. When you buy the put option to close, cash flows out. So let's break down the differences between, let's look at just specifically buying and then selling put options. See how they might be different. So buying a put option. As we've been discussing, buying a put option gives you a right or choice to sell shares at a predetermined price, which is called the strike price, in a given time frame, which is called the days till expiration or expiration date. As we discussed on the previous slide, money flows out to open the position and money flows in to close the position. Ideally, if you are wise and profitable. Basic ways to profit from buying a put option. It's the basic concept of buy low, sell high. You close the position at a higher price than you bought the put option at to open the position. You buy low, sell high. That's basically what's going on. At this time, a lot of people will think about, wait, that doesn't make sense because the stock price is going down. I know the stock price is going down. I know. But we're not, in this moment, we're talking about opening and closing a position and just money flowing in and out of your account. Right? So you kind of have to keep it in these different compartments. Part of the whole learning process, I guess. Another way that you can profit from a put option, from buying a put option, it's a little less common nowadays, but you buy the put option as stock insurance, as we talked about. Very similar to buying car insurance. Buying put options, this is a bearish strategy. What do we remember about bearish? What does that mean? It means when something's going down. So as we were talking about on one slide ago, this is a strategy that's profitable when the stock price, the underlying, is going down. Even though the stock price is going down, you're gonna buy your option at a lower price, and as the stock price goes down, you eventually close or sell your option at a higher price. There's something I have to point out to you. Time is against you. Yes, it is. Yeah, you're right. I'm not quitting my day job to pursue a singing career, but I don't mind singing to you now and then here. So time is against you. Now, remember this? We talked about this Greek, time, theta. So there's negative theta, just like when you, in your car insurance, if you have 30 days of car insurance and day one, you got all the time value. But every day that goes by, your car insurance is worth less and less and less as long as your car isn't in an accident, right? If you're a safe driver, no accidents, by the time you're 15 days into that contract, you've kind of chewed up 50% of your premium. Here's another thing, is that the profit is capped by the stock going to zero. Now, why is that? We talked about the bearish strategy. We talked about this strategy is going to profit as the stock price moves down. How low can a stock price go? How low can it limbo? It can limbo all the way down to zero. The lowest number the stock price can go to is zero. So it's capped at it going to zero. However, remember we talked about contract size. What did that mean? It means in the US stock market, one option contract equals 100 shares of the underlying stock. So even though you're capped at going to 0 because you have leverage of using 100 shares, even if you just get you get a $10 drop because of that leverage, it might end up being really, really profitable for you. It might. Your loss, how much money you can lose with this strategy, is limited to the amount paid. And you 100% know before you open this position how much money you could potentially lose. If you're going to buy a put option that costs $100, you know for a fact before you buy the put option that the most money you can lose is $100. Sounds great, right? You know how much money you can lose. You have leverage. You could potentially make a lot of money. However, this strategy has a lower probability to profit. It has a lower probability to profit. Let's take a look at that. A stock can move in 3 directions. It can go up, it can go down, and it can go sideways. So this is a bearish strategy. Remember, buying put options, you profit when the stock goes down. So if the stock moves up, you're not profiting. If the stock moves sideways, you're not profiting. If the stock moves down, you might profit. You might profit. Remember in the option Greeks, back in that jargonish terms I talked about, it might come up again. You got to kind of understand it a little bit for things to make more sense. And remember, I talked about the intrinsic and extrinsic value, how that plays into your potential profitability. So those option Greeks, not only do you have to be right in the direction to profit with buying a put option, you also have to make sure that those option Greeks have to be on your side. So for example, if you bought a put option for 30 days and the stock went sideways for 28 days, and on the 29th it started going down, and on the 30th day it's moving down more, there's a good chance you're not going to be profitable because of the time decay. So just keep in mind that there's these other things that makes it difficult. Even though you have this leverage, even though you could potentially make a lot of money, the probability of being profitable and highly profitable, it's a little bit harder. Does that mean don't do it? No, it doesn't mean that. It just means understand that it takes a little more skill. Let's look at the S&P 500. This is a 12-month chart. Each one of these red or green things, which is called a candlestick, represents 1 day. Now, just for the sake of this demonstration, just go along with me, because hindsight is 20/20. If implementing these strategies were as easy as I'm going to make it sound, then everybody would be retired, and that would probably be it. So it's not as easy to implement it when you're actually in the moment. But just for training purposes, just feel this out with me, and you can look at when buying a put option could potentially be lucrative. Now let's say you've been trading for a couple of years. You got a little more experience under your belt. You got a sizable account, so you can easily trade an S&P 500 that's going to be several hundreds of dollars here. Now you're watching the S&P 500, and you've been watching for a little while. You notice right here it hits this little ceiling, and for X amount of days it drops down to right here. It bounces back up. Now while it's going up, you're looking to see if it's going to go up to the ceiling. You see it doesn't. It goes about halfway, sort of in line with this congestion here. It drops down. You're looking to see if it's going to go lower than where it touched here, but it doesn't. Starts going back up, wavers a little bit here. Then it starts going up. Now you're looking to see what it's going to do right here. You see it kind of blows past this. Wavers just a little bit, but then it keeps going. And then it kind of does that same thing here. You see it come down and touch this point, which when you look over here is in alignment with right about here. So now kind of thinking, all right, is it going to keep going up? You see that it's doing that, drops down here again, It's not looking super bullish. What does that mean? Going up, right? So it's looking a little weak on the bullish side. So you're getting a little concerned, right? You see it now, it passes this highest point again, but it's kind of weakly passing it. And you notice on this day, boom, it dropped down hard back here in this area. Comes down here again, testing right here. Now you're looking to see, is it going to test all the way down here? It goes up. You're looking to see if it's going to pass this congestion. Is it going to make it up here and go past that? It doesn't. It starts going past. Now you're looking for this point. It blows past that, right? Hits all the way back down here. Now look at, you're several weeks. Now you're back down to the several week over here. So now you're thinking, okay, this is not looking good. Should I consider buying a put option? Because it looks like the S&P 500 is getting weak. You want to get some confirmation. So you see it start going up again. You're looking, what's it going to do around here? It gets around here. See that long candle right here? Now it kind of slowing down. Hits up here. Is it going to keep going? Is it going to break through this? No. Drops back down to here. Having a hard time breaking this line, which is in alignment all the way over there, right? Isn't that interesting? So now you're thinking, I don't know. This looks like it's potentially, kind of weak. So at this point, maybe you decide to buy a put option. And S&P 500 drops down here. Within about a week and a half, whatever, you potentially have made a profit. Maybe you decide to close that trade. And then it rallies back up here. See this congestion right here? Can't do it. Drops back down here. Now you notice it's back around that same place it was here. Now you're thinking, is it going to drop further? You kind of think, gosh, I wish I wouldn't have closed that position. Wish I would have held it. But then all of a sudden it starts rallying up, rallying up. Now you're looking back to the left. You see that it gets around here. What's it going to do? It had a hard time going past that. It goes a little bit past that. Oh, it starts breaking down though right here. So you decide to buy another put option. And then eventually, ooh, look at that. You're just rewarded. You're riding this down. You buy this put option around here, around a strike price of, let's say, 450. And now you're down here around 390. It's more than likely, it would be an extremely profitable trade. So that would be one way you could profit from buying a put option. In the same scenario, what's another way you could profit from buying a put option? Instead of going through, let's say that same person's watching it, seeing what's going on. In here, like the person's like, oh, okay, I'm feeling a little concerned the S&P 500 is going to break down. I want to insure my stock position. The person has 100 shares of stock. So they say, you know what? My stock is right here, right? They're right in this area. And it's kind of trading around 450. They buy an insurance policy for 440. Sure enough, stock goes down here, down to 420, depending on how long of days till expiration. Maybe they bought it for 1 year. Stock rallies up here, but by the time the stock is way down here, they're able to sell their stock for 440. Now, is there more detail to it than that? Is it a little more complicated than that? Yes, but that should give you a general idea of how to work this stuff. So let's get into selling the put option. Selling put options, right? This is the opposite side of buying. Sell a put option gives you an obligation. You take on an obligation to buy shares at a predetermined price, which we know is called a strike price, in a given time frame, which we know is called the expiration date, your days till expiration. Where does the money flow when you open the position? The money flows into your account when you open the position. If you close the position, the money is going to flow out, right? So money flows in to open, money flows out to close, and you have an obligation. Basic ways to profit selling a put option. There's two basic ways to profit selling a put option. The first way would be to close the position at a lower price than when the price you paid to open it. Let's talk about that one first. Let's say you sell a put option and you take in $10. You sell a put option, you receive a premium of $10 for a 14-day expiration period. Let's say 7 days goes by, and during that 7 days, the option value has lost $4 of value. So you originally took in 10. $4 has been lost to the option value due to time decay, and now you could close the position for $6. So if you took in 10 to open and 6 flows out to close, the difference is 4. You'd made a $4 profit. That is one of the basic ways to profit selling a put option. Another way would be to let that contract expire worthless. So at 7 days, the put option had lost $4 of value. Now let's say you ride it out for the next 7 days, and during that time the stock basically kind of goes up and sideways. So at the end of the contract period, the stock is above the strike price, right? That predetermined price. There's no value there. So the contract expires worthless and you just keep the $10 of premium. Another way is to acquire stock. Let's say the same example. At the end of those 14 days, what if the stock is below the strike price that you sold, that predetermined price? Well, then you are obligated to buy it, right? And if you have the money to buy those shares of stock, you could potentially get shares of stock that you wanted to own anyways, which technically is called selling cash secured put options. So you get premium and you could potentially get stock. Although this is a little not as common, but it is basic. So selling put options, this is a bullish strategy. This works well when a stock is moving up. Time is on your side. Yes, it is. You probably knew that was coming, right? Time is on your side. Now, when you bought the put option, you had negative theta. So when you sell the put option, you have positive theta, which means the passage of time works to your profit. Now, in this case, your profit is capped by the premium you received. So in our case of our example of selling a put option for $10, no matter what the stock does, the most you're going to make is $10. The amount that you can lose, though, is difficult to predict. Unlike buying the put option, which you knew before opening the trade, you knew the exact amount of money you could lose going into the trade, this is not so. You don't have a defined risk before going in. The amount of money that you could potentially lose will only be known when you're close to the day of it expiring and potentially losing money. However, you have a much higher probability to profit. Let's look at that probability of profit. You probably remember there's 3 ways a stock can move: up, down, sideways. So in this, it's a bullish strategy. So if the stock moves up, you're profitable. You make money. If the stock moves sideways, you're profitable. You make money. If the stock moves down, you might lose money or you might make money, because it depends how far down it moves. And it also depends, if we go 1 or 2 slides back, if you were selling cash secured put options and you wanted to buy the stock anyways. So this has a much higher probability of profiting, because at minimum you can profit 2 out of 3 ways. In some cases, if you're selling cash secured put options, you could potentially profit 3 out of 3 ways. So way higher ability to be profitable. This is the same image of S&P 500 for 1 year on the daily chart. Now, remember, buying a put option worked really well through this time frame here, but selling a put option, unless you're selling cash secured put options and you want to buy the S&P 500 at this lower price, it's going to be pretty tricky. I mean, you could see that the S&P 500 is going down. It rallies a little bit here. It goes down here. You see it hit this. You could potentially give it a try. You see that there's this big bullish candle here. Maybe you could sell a put option here and hope that it's going to go up. In this scenario, looking at this chart, selling cash secured put options would probably be the best thing to do. However, if you don't have enough money to buy the shares of stock, then with this particular stock, maybe you would just avoid selling put options on this. Maybe this stock, looking at this chart, you just stick with buying put options. So we talked about some pluses and minuses of buying put options. We talked about some pluses and minuses of selling put options. So which is best? Based on that chart of the S&P 500, you might be thinking that buying put options is best. What if I were to tell you that neither is best? What if I were to tell you to use the right strategy for the right situation and in the right time of your life? Is a saw or a hammer or a drill better? Which one's better? Just depends on what you're trying to do, right? Depends on what's going on. So it probably makes sense to use the right strategy for the right situation when we looked at the S&P 500 chart. But what do I mean by time in your life? Well, here's a couple different things. What if you're going to have your first baby? You want to be trading, but you're going to have your first baby. Your wife's going into labor. Maybe you would look at selling put options that gives you a higher probability of being profitable versus buying a put option where you got to kind of monitor it a little bit more. Now, what if after your first baby, what if you end up having 3 babies and you work 40 to 60 hours a week, let's say 50 on average. So you have a really busy family life and you have a really busy work schedule. Maybe you go with what your lifestyle allows you to do easily. Now, what if you're single and inherited $500,000? So your situation in life, the time in your life, can have a lot to do with which strategy, because of the maintenance, because of all these different things. So which is better? It just all depends. Use the right tool in the right situation. Now, you might have guessed by now where I think the easiest place to start is. Because there was only one strategy that I talked about when it came to selling put options on the S&P 500. And if you looked at the pluses and minuses, which direction you can be profitable when you're selling a put option, there was a maybe, right? 3 out of 3 selling put options, when you sell cash secured put options, you could potentially be profitable in 3 out of 3 ways. So I believe the easiest place to start is selling cash secured put options, because at contract expiration, only one of 2 things will happen. 1, you keep the premium. Or 2, you keep the premium and you get to own a stock that you wanted anyways. Now keep in mind, you have to sell the cash secured put option on a stock that you wouldn't mind owning the rest of your life, and be buying it at the strike price, at a price that you feel comfortable at buying it. At the end of this video, I'm going to link to a video that it's specifically about generating income through selling cash secured put options. Watch that if you want. And I'll also link to a different video that talks about why I think, what are some of the things that I really like about selling cash secured put options. And I got one more thing for you. If you go to ihavesuccess.com, put your information in here, then you're going to get two things. One, you're going to get a list of 3 options that I personally sell cash secured put options on. These aren't the only 3 that I do, but these are 3 that I really enjoy, and I explain why I enjoy them. And you'll get 3 underused tactics to transform your financial results. These aren't tactics that are specifically applicable to the stock market, but they will help you in the stock market. They can help you with anything. Go there, check that out, subscribe to the channel, like, comment, especially if I made some mistakes, or if you want to give me some feedback on what do you think I could do better. It would be greatly appreciated. Give me any type of feedback you want. I hope you guys have a fantastic day, and I hope to hear from you soon. Aloha.